On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Let's run through some of last week's key events and releases, then let's turn our attention to the week ahead. Well, markets were down across the board last week. As you would expect, we've seen that sharp risk-off tone prevail in the wake of the conflict in the Middle East and surging oil prices. So we saw the S&P 500 index in the United States fall 2%. That was its worst week since October, and other global indices have fallen harder. And that's not unsurprising because the US has been a bit of a laggard this year. Other markets have risen much more strongly into the lead up to what you saw last week, which means many of them, fell back a little more sharply. So the UK, Europe, Japan, all down close to 6% each last week, while emerging market shares fell 6.7%. The Australian ASX 200 and the local market, the NZX 50, held up much better. Aussie was down 3.8%. Us here in New Zealand, much more resilient. We were down just 1.5%. Now, many of those markets, despite the declines, are still up year to date. Australia is up 1.6%, the UK is up almost 4%, Europe's flat, Japan's still up 9%, even after falling almost 6% last week, and emerging market shares are up almost 7%. The US is down about 1.5%. So we've seen some volatility, we've seen some weakness, but many markets are still looking okay on a year-to-date basis. Now, I do have some thoughts on what happens from here across markets and what you should do to protect yourselves in terms of looking at your portfolio and making sure you have got some insurance policies in there, but I'm not going to talk too much about that. I'll end up verging too much into giving financial advice, which I'm obviously not allowed to do in this sort of public forum. But what I would say is talk to your advisor. If you're with us at Craig's, then we have lots of material. Many of my colleagues have written some great reports about which stocks, which sectors, which asset classes are likely to go up, go down in the wake of what you're seeing, how investors should position for it, what they should be thinking about, what's happened in the past. So touch base with your advisor, go on the website, you'll find all of that. If you do business with someone else, well, go to them and ask them what they've got that they can share with you. I'm sure all of the fund managers and investment advisors and wealth managers out there will have lots of material that can keep you on track during a period like this. US crude oil was up 36% last week. It finished the week at over $90 a barrel, 90 US dollars. Now that is the highest price that we've seen since 2023, I think, and it's actually the biggest weekly gain, up 36% in a week. That's a lot. Biggest weekly gain in the history of the US oil futures contract, and that contract has been around since 1983. So given the difficulty in predicting when this conflict and therefore the oil price rise, when that will subside, investors have started to get quite nervous about the impact on inflation and monetary policy. Markets have pared back expectations for rate cuts in the US this year. They're still expecting a rate cut or two, but the odds have dropped, and they're actually now picking at least one hike in Europe. It wasn't so long ago that markets were pricing in some chance for another cut. Now they see a hike coming in Europe. So we've seen that flow through to interest rates and bond prices. Interest rates were up everywhere last week. The US 10-year Treasury yield rose from 3.9% to 4.1%. And here in New Zealand, our 5-year swap rate finished the week 20 basis points higher too. It finished at 3.7%, started the week at 3.5%. Some of the key releases last week that we'll talk about outside of obviously the conflict that you're seeing and what that meant for oil prices, energy prices, we did get the ISM indices in the United States, the Institute of Supply Management Indices, which are essentially activity indicators. These were impressive again in February. The ISM Manufacturing Index, that was little changed at 52.4, which is its second consecutive reading above 50, which is good, close to the highest since 2022. New orders were healthy, the second highest in 4 years, but less encouragingly, and we're talking about inflation again, this is before what you've seen on the oil price front, the prices paid index surged to over 70, which is well above what we saw in January, and it's actually the strongest since June 2022. So not great news, some good and bad there. The services ISM, that was equally impressive. It jumped from 53.8 to 56.1. That's the highest in 43 months, well above forecasts, and pleasingly, the services ISM prices paid index slipped back a little bit. It was actually the lowest in almost a year. So much more good than bad in those ISM indices, which covered the month of February. The jobs report, again, good and bad, but probably a bit more bad than good. Much weaker than expected in February at the headline level. The pace of jobs growth moved into reverse in February. Non-farm payrolls fell 92,000, which was well below estimates for them increasing 55,000, and that was the lowest we'd seen since October. The unemployment rate increased slightly. It pushed up to 4.4%. Markets expected it to remain unchanged at 4.3, went up to 4.4. However, there was one piece of good news, and that was that the underemployment rate, which is a broader measure of labour market slack, that actually fell from 8.1% to 7.9%. So that's the lowest we've seen in 7 months. So all in all, not too bad from some of those US releases, but a few things to keep an eye on. Here in New Zealand, we got the results of another dairy auction, and prices just keep surging higher. It's been fantastic what you've seen for the dairy farmers out there. The GDT index was very strong, up another 5.7%. That was the 5th consecutive rise we've seen in a row, and that's the longest streak in about 2 years. So after last year, where global prices slumped 17 odd percent, prices have now rallied more than 26% over the first 2 months of this year, and they're now at their highest level since April last year, and I think they're only about 5% below their peak, which came in May the previous year, 2024. So after cutting its milk price forecast twice in late 2025, Fonterra has lifted it, and it's now got a midpoint of $9.50, which is above what it had before. It had $9 before, so now it's up at $9.50, and plenty of people saying, well, could we be back towards that $10 mark? You know, who knows? We'll have to wait and see. Dairy prices do tend to follow the price of other commodities, including oil. Higher oil prices can often put upward pressure on import costs, such as fertilizer, and there are quite a few oil-producing nations out there that are also big consumers of dairy, and that can see demand increase. Oil prices go up, those parts of the world have got more money coming in from the oil they're selling, and they sometimes spend that on more dairy and other proteins that we sell. So there is a bit of a link there, so watch this space. Turning to the week ahead, and the Middle East will be a key focal point in the days ahead as investors consider what a protracted conflict could mean for energy prices. It's not just oil we need to think about, but we've also got to think about natural gas. And that all flows through to inflation, that all impacts monetary policy settings, what central banks are doing, and economic growth. And all of those things together affect what asset prices are doing and whether corporate earnings is growing and whether jobs are being created or lost, and so on and so on. So lots to watch, and I think that is what people will be thinking about most. But that's not all. There are some data highlights as well. We will get 2 inflation reports out of the US. We will get the CPI report for February, that is out on Wednesday, and we will get the PCE inflation report for January. That will follow on Friday. That second one still playing a bit of catch up. So one of these reports will cover February. That'll probably get more attention because it is more current, and the other one's still important, but it will be delayed by a month. So the CPI, that first report that's out on Wednesday, expecting to see headline CPI running at an annual rate of 2.4%, the core CPI at 2.5%, so not a lot of change there for both from January levels. The PCE inflation report, and all of these measures are calculated slightly differently, which is why they are a little bit different. But PCE inflation expected to be running at 2.9% at the headline level and 3.1% at the core level. That would actually be the highest we've seen since March 2024 for that core PCE inflation rate. This all comes ahead of next week's Federal Reserve meeting. The March Federal Reserve meeting takes place next week. It is on the 18th, which I think is a Wednesday, which means it'll be out on Thursday morning, New Zealand time, just as we're having our third or fourth coffee, about 8 o'clock in the morning usually. No change expected, but that one really will be in focus because we'll all want to hear what does the Fed think of the impact on oil prices from the Middle East conflict and what that could mean for the changes to monetary policy that they're expected to make later in the year. I think we'll also get a CPI report out of China that will be interesting. Here in New Zealand, well, people are starting to think about the election. We've had a couple of polls recently that have not been at all friendly to the current government. So that is something I think that people will be watching and beginning to think about as we sort of move towards that more intense campaign period. We will also get the latest quarterly survey of manufacturing that is out on Thursday. We'll get a monthly migration report that is out on Friday. And while it's unconfirmed, it's possible we get a housing market report late in the week. The REINZ report, usually out about the 10th or 11th business day, and this Friday will be business day 10. I haven't seen anything that confirms that, but you never know. If it doesn't come out late this week, that'll be early next week. On the earnings front, not a huge amount of companies reporting, but as always, a few interesting ones. We've got Oracle, we've got Saudi Aramco, we've got Adobe, and we've got Dollar General internationally. So Adobe will be quite an interesting one. That is out on Thursday in the US, so that will be Friday in New Zealand. And who the Warriors got? They have got the Sharks, I think, again at Go Media Stadium for round 2. That will be interesting after that cracking win on Friday night. I hope all of you watched that. That is epic to get such a good win under our belt against a stacked team like the Roosters. The Roosters are actually my other team. Eastern Suburbs was the team I liked before the Warriors came into the comp in 95, so big Roosters fan, but not when they're playing the Wars. Anyway, that's all for today, so enjoy your week. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.